There we go. Okay, we'll make it real fast to talk about who we are, and then I want to introduce your speaker for tonight. Can you guys hear me? We're good? Okay. So Davis and Hodgdon, we have been around for 30 years. We have offices in the Burlington area and also in the Rutland area. We work with small businesses, entrepreneurs, startups, also businesses that have grown quite a bit and are also looking to sell or to move on. Matt, who's going to be speaking with you, he specializes in a lot of our remote bookkeeping, but also working with entrepreneurs that are just getting started for that process there, yeah. We're also the 17, 18, and 19 best accounting firm in Burlington by Vermont Business Magazine. Thank you. I feel like we should put that up here somewhere, but we never do. Okay, so I want to introduce you to Matt Cleare. So Matt is he's one of our managers. He's got over 11 years of experience, both in public accounting as a CPA, but also as a controller and a chief financial officer in the private sector. He specializes in accounting and business management, strategy, tax, finance, yada, 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 all of that great stuff. He's a certified public accountant, and he's also a chartered global management accountant as well. In his free time when he's not with us, him and his wife are actually currently navigating the whole business ownership world. They own a retail shop up in St. Albans. So they're also kind of going through a little bit what you guys are going through as well. In fact, his wife is part of the CWE cohort this year, this session, so we're super excited about that. With us tonight also, we have two other of our associates with us. Ryan Black-Deegan, who's in the back of the room. He's a supervisor with us and a CPA, so he'll be around as well to answer any questions you guys might have afterwards. And Donna London is one of our accountants / future CPA, and so she's here with us as well. Without further ado, turn it over to you, Matt.
Thank you. I apologize in advance. I'm regaining my voice currently. So we're going to cover quite a bit of ground today. There is time at the end that we've allotted for questions. I've got my two plants in the crowd and myself who feel free to sort of corral us at the end of this thing. But if at any point something I said is unclear to you, you have a follow-up question that's relevant to the conversation, don't be afraid to raise your hand and shout it out. The main goals that I have for this presentation is not necessarily to make everybody in this room an expert at accounting and finance, but really just to make you a little bit better equipped as most of you are entrepreneurs. And as artists, you all are many of you are small businesses of one person, but it's still, you have the same concerns, just on a different scale. Basic financial reporting questions that I'm going to take us all through now is you just, generally if you are running your business like a business at this point, what financial reports should you be looking at? How often does it make sense to be looking at them? And what is the key information that you want to get out of these things? Because there's a lot of information present. The main package, and this is something we recommend to every client that we work with, every entrepreneur that we work with, and pretty much everyone who's at a stage in their business where they are generating some sort of financials out of accounting software or even within Excel. You want to be looking at a comparative balance sheet, comparative income statement, and I've bolded both of those comparatives because I'll explain the importance of that later. In accounts receivable aging, accounts payable aging, and bank reconciliations monthly. Many of you may not have a full grasp of what a balance sheet is. That's great for us in our profession. But in short, the balance sheet is a snapshot of where the business is at a specific period of time. It's not a range of time. It's comprised of all sort of the hard and intangible assets, debts, and what you've invested in the business, just at any point in time, so you can tell generally how the business, the general health and well-being of the business. Actually, assets. So assets are going to be the things that your business owns and are generally positive things to have attached to your business. Think cash, receivables, so that's what your customers owe you at any given point in time. Inventory, which can be either something that doesn't really matter to an artist as they just start out, or something that matters a whole lot to an artist who's taken it to that next level and sort of developing a manufacturing concern. And then things like equipment, if you're fortunate enough to own a building. Those sorts of things comprise the assets portion of your balance sheet. Your liabilities are going to be really, in essence, your debt, but there's a lot of different fancy categories we have for what that means. So payables are going to be amounts that you owe to your vendor. Bank notes, if you owe money to friends and family members that you borrowed from. And if you've got anything called accruals, which won't be a concern for most people in this room, other than an accrual it's an expense that you haven't received the bill for yet. And one thing I would say in terms of vocabulary here, I'm going to present all this based on an accrual basis of accounting. A lot of you may have heard, cash basis, accrual basis. I urge people to think of their business in terms of accrual, because even though you may not use the same words I do, you already think that way. If somebody hasn't paid you for something, you know that they owe you that money. That's an accrual basis. You know that just because you haven't gotten your electric bill yet, that doesn't mean you don't have an electric bill coming. So the way we all manage our personal finances is very much already on an accrual basis of accounting. It's just learning the vocabulary and becoming more comfortable with the terms. But I guarantee most, if not all of you, already think that way. And then equity, really in a nutshell, is at the bottom of a balance sheet, and it's in essence what you've left invested into the company. So it's money that you've either put in or money that your business has earned that you've left in the business. So the equity goes up when you make money, it goes down when you lose money, and it goes down when you take money out. The income statement, and this is where most entrepreneurs have a better grasp. Most people think in terms of profit and loss. That's going to be a summary of revenue and expenses for a period of time, where the balance sheet is a snapshot at one specific point in time. The income statement is going to be run for last month, for the last 6 months, for the last year. So it's how did the business perform? How profitable was I for a period or a range? The relationship between the balance sheet and the income statement is both very simple and important to understand, and I'll explain why it's important in a minute. Net income ends up on the balance sheet in the equity section, and that's where we come to a lot of you may have heard debits and credits, and every entry has an offset. And what in essence that means is, if everything on your balance sheet is a balance that you're comfortable with and you understand and you know to be real, you may have classification, but you always know that this number is right. So that's where a lot of business owners, and you'll see it especially when people are starting out, they don't think about the balance sheet, and secretly something's been building up there over a period of time that when you see the effect of it, really changes how your business did or corrects your vision of how your business did, and can be sometimes a little bit of a shocker. Why look at the balance sheet? As I mentioned before, it's the barometer for the health of the business overall. It doesn't tell the whole story, but it tells how things look at a given point in time. Do I have enough cash and receivables to pay all my debt? You can tell on one simple one-pager if that's going to be true or not, and it'll help you identify if it's not, and you can maybe take some actions before it becomes a crisis. And the other big reason, which is why most people end up being interested in it, is if you are pursuing any sort of loans or bank finance, that's what they're looking at. So understanding your balance sheet, understanding what a strong balance sheet looks like, and how to plan and set your course in that direction can actually help when it comes time to secure any sort of outside finance. General questions to ask, it's how is my company funding operations? Things like my receivables are really high, but my cash is always really low. That can tell you maybe you're letting people string you out a little bit long. Maybe you need to spend a little bit more time reviewing receivables, a little bit more time on the phone. Am I putting too much money into inventory? And we'll get to inventory for those of you that's a concern a little bit later on. But generally speaking, you want your inventory as low as it can possibly be all the time, because that's your money. You can't spend it when it's sitting in a corner over there. And then equity positions steadily increasing or decreasing. If equity is always going up, maybe it's time to take a little bit of cash out. Why look at the income statement? Again, this is usually an easier one for entrepreneurs to figure out. How profitable am I is the main concern there. Looking at it comparatively is going to be a point that I'll make a little bit later on, because that's where you start developing trends or identifying trends that are developing. Your income statement can tell you a lot, even at a glance, if you know how to look at it. Questions to ask. This is where you can see things that either stick out as outliers or cause you to question. I've got 3 different products that I'm selling. The margins on them don't look, is there one that maybe it makes more sense for me putting my effort in? Where am I spending my time versus where am I making my money? Are there any costs that seem to be heading in the wrong direction? Is it maybe time to address how I'm pricing things? This is the report that's going to help you reach those conclusions without killing yourself in analysis. Why comparative? So I've given an example here. This would be a jewelry maker. 1 year's worth of operations. Here are the sales figures. It's a good-looking report, if I don't say so myself, but it's not telling you a whole lot, right? You're not getting any sort of insights from looking at it this way. When I put 2 periods next to each other, however, now this is starting to tell a little bit of a story. I don't necessarily need to go into a ton of detail, but I can see, all right, I'm noticing your bracelet sales are up a little bit, and something is going on with necklaces here. I can't tell if it's 2018 was a stronger year there, or if 2019 is just sort of a return to normal. And this is why I always recommend, if you're going to do any sort of comparatives, you at least do 3. I actually recommend 6, which seems like overkill to a lot of people, but this is why. I'm sorry about that. A completely different story when you start looking. Now you can pick out which year is the outlier. You're starting to spot some trends, and I think you don't have to be a math whiz to tell. If I'm putting my efforts anywhere, it seems like earring sales are the ones that are taking off, while everything else is sort of hovering. Real quick, the other 3 reports I talked about, the AR aging is a standard report that's going to come out of any accounting package. And what it simply is a list of who owes you money and how long have they owed you money. And that's a way to sort of filter out a lot of the background static and determine, if I allot an hour a week to make collections calls, who am I calling? And as you start monitoring those things, you can almost know who you're going to need to call a week before you call them, or who do I not need to worry about because they always pay on the 5th week. Same thing with the AP report in terms of, how are my payables, and those are going to be your vendor invoices, your utility invoices. For most of you, that's going to be any supplies that you're getting on credit, if you're fortunate enough to be getting that at this point. And the big thing that the AP report is going to help you determine, am I constantly getting dinged with late fees because I'm just not keeping up with this? Am I maybe missing out with discounts? Some of you may be getting prepaid terms, or 210 net 30, where you get those little discounts on the front end, which you should absolutely be taking anytime a vendor offers you. And then it will also, by regularly monitoring this and sort of monitoring your payables, sometimes this is the canary in the coal mine that tells you do have a cash problem, because if each week it goes up a little bit more than it was the week before, and then up a little bit more than it was the week before, this may indicate, before you really feel uncomfortable, that something is trending in the wrong direction and it might need some attention. And then the bank reconciliation. There's a lot of good reasons to do a bank reconciliation, particularly if you use an outside bookkeeper. Any business owner should be reviewing the bank reconciliation. The main reason all of you should be using the bank reconciliation is it reaffirms how much money you actually have. You'd be amazed at how many clients, when you go and you actually review the thing, there's deposits in there that are from 3 years ago that still haven't cleared, and it makes that number, what's in my bank account, a lot more meaningful if you know for a fact it doesn't have a bunch of old stale transactions in there that need to be cleared out. This is, for any of you who are managing your businesses by your checkbook, this is balancing the checkbook and doing it on at the accounting software level. So that's the basics on the financials, and probably the boringest part of this presentation. The next, we're going to drill down a little bit deeper into understanding your costs, or what people refer to as your cost structure. And very simply put, this is, some of you may have heard what a variable cost is versus what a fixed cost is. I've also added another category called unexpected costs, which can be fixed or discretionary, but I'm not going to bore you with those terms. And then a very important number 4. I'm going to explain a little bit about that. I will say, for those of you who are maybe in more of a service industry, don't tone this out because you still have variable costs. You may not have, the examples aren't clear enough, but if you think about it, what I'm about to go through will still apply to your business as well, just maybe not in the same ways as those of you who are more manufacturing. So fixed costs are really simple. If I had to boil it down to a quick one sentence, those are the checks you have to write every month, no matter what. If I sell 100 things, if I sell no things, I'm writing the same check. The reason why it's important to kind of draw those lines is that helps you determine something I'm going to get to a little bit later, which is what your break-even point, which helps you determine how much do I need to sell just to make sure that this thing is floating at level. So some examples of that are, the big ones are going to be rent. If you lease a space, you lease equipment. If you have any salaries that you're paying, which may or may not be a concern. Some people look at utilities as a fixed cost, and that's the other thing I'm going to get to a little bit later. I'm going to give you some textbook definitions, but a lot of this you need to reflect on how it's actually practical to your business, and I'll give some examples of where the textbook definition would definitely steer you wrong in how you can choose to take this information and actually analyze aspects of your business. And then there's the variable costs. So the variable costs are those things that change as you sell, or as you produce. Tends to be more true for those of you in the manufacturers. So for instance, if you're a jewelry maker again and you do a lot with copper wire, you're going to buy more copper wire as you sell more jewelry. The costs go up sort of lockstep with what your sales and production goals are. So that's going to be your raw materials that are being consumed in the process. That's going to be if you're paying any sort of direct labor. So people, if you're fortunate enough to be big enough that you've actually brought on some people to help, their wages go into there. Depending on if your operation burns enough electricity or propane that utilities can become a variable cost as well. But they're all production driven. So those are the two things that you need to really understand and be able to categorize all your expenses into to be effective at analyzing sort of the break-even aspect of your business. And then there's those unexpected costs. And unexpected costs really fall into 2 categories. You probably always have to pay for the insurance, but at the end of the day, you probably could get away with not doing it. Maybe not get away with it, but you could choose not to write that check. These are somewhat discretionary. A lot of times, there's only one time annually that it appears. And it's the kinds of things that you always kind of forget as a thing until you have to write the check. You want to have these in your back pocket, particularly when you're doing a break-even analysis, and understand them when you're making longer-term plans and trying to figure out how much you need to produce, but they're not necessarily as apparent and in your face as those other categories. And then the big advice, particularly when you're starting out, it can be really hard to pay yourself. And what I mean by that, it doesn't mean you need to pay yourself something exorbitant, but you do have to be realistic about what you need to get out of the endeavor and plan around it and adjust quickly if the reality isn't becoming what you can sustain. That's where those horror stories happen. Is you get down in the weeds and you get into a little bit more of a survival mode, and then you never pick your head up long enough to realize, hey, I needed to adjust this price here, or I was actually getting gouged here. I like to make the point that if you're living off credit cards, you aren't really breaking even. It's okay for entrepreneurs to certainly start their businesses shooting for break even, and even for planned dips and tight times. You just want to be able to see that coming, and you want to be able to have a plan. Here is why this is okay right now, because if I continue my efforts and I start hitting my plan, this is where I'll be in 6 months or a year. So you want to plan to reward yourself for what you're doing, and make sure that you're realistic about what you need to get out of the enterprise. There's sort of a closing thought in this section. It's really, by understanding your cost structure, it's going to help inform some of the other things I'm going to talk about tonight, but it's really fundamental. It's kind of the first thing you need to get your hands around, particularly when, for artists, is because you get a lot of costs coming in. It helps you price, it helps you understand cash planning, it helps you understand, just really everything about longer term planning. So you guys have heard me talk about this a few times already tonight, and that's the break-even point. So the break-even point is a mathematical calculation that everyone in this room is capable of doing. And once you've taken down all your costs and you've broken them down to where you get, I know what my variable costs are now, I know what my fixed costs are now, you can calculate it. And what it simply is how much do I have to sell before I'm at zero? Before I'm no longer funding this enterprise. And the reason why that's really important to understand is it helps you understand how much do I have to sell before I can start taking something from this. I kind of jumped the gun and explained a lot of this already. And to help illustrate this, I've given you a really good example about somebody that makes sculptures, and this is about as creative as an accountant gets. So, because I wanted to illustrate the math, I hope this is okay to follow. I've used a lot of words, but in general, so this Burlington Gardens company who produces garden sculptures, see, art, has gone through the excruciating process of identifying what their fixed costs. So, they got a building lease, they've got some equipment they rent, they're fortunate enough they have an office manager who's on salary. That can be important to determining which bucket you put an employee if you have them. So each year, they got to pay $60,000 whether they make one sculpture or whether they make 100 sculptures. And next, they've gone through and they've identified, what are the variable costs, the things that are going to go up as we produce. We've got raw materials, direct labor, sales commissions, so they're fortunate to have someone selling for them. And they've costed that out at about $25 per unit. So for each garden sculpture we make, it costs me about $25 to produce it. On the market, we price each one at $40. So this is what the break-even would look like in the scenario. I take my $60,000 fixed, and I divide them by the difference between what my sales price is and my cost of goods, so the profit margin on each unit that I sell. And so real quick, I now know I need to sell 4,000 sculptures before I make anything. This is critical information to determining how you want to proceed, if you're priced correctly, if you need to reevaluate the materials that you're putting in. Understanding this fundamentally can supplement a lot of more complicated planning that people like me are going to recommend that you do. And I will recommend later that you do it. But this is it's an incredible tool. If nothing else, it gives you a lot of peace of mind of just having an idea of when this thing's going to pay off. It's really easy to overthink the break-even point analysis. I have seen people drive themselves insane trying to get down into the tiny little minutia of, how many inches of copper wire am I putting in each one, and how many times do you think I need to turn on the light switch to make that a variable cost? If you make it that complicated, you're not going to do it. So make it simple, right? The textbook is going to tell you the wages that you pay employees to produce things are variable. And that's technically correct. But you know what? If you're not going to cut people's hours or lay them off, if production goes down, make it a fixed cost. That's where you kind of have to gut check what the textbook's going to tell you versus how you're practically running your business, and what's the truth of, which costs are really fixed to me versus are truly variable, and that I won't have to write that check if things start going downhill on the production side. All right, projecting for the future. Why bother? I'm a big fan of this, and particularly the third bullet here. I'll get to that. So I think every business should have some sort of projection, and really what that is, look out into the future and define where you want to be. In 2 years, I want to be making $50,000 off of this clean, and I want, to have my own studio space, and I want, have that idea of where you're going, and then sort of plan backwards from it. And that's where a projection sort of helps roadmap the way that you're going to get there. I've put 2 words here that are kind of verbose to begin with, and I've used the word verbose, so that's also verbose. Dynamic versus static. I think the traditional way people talk about this is going to be more of that static. So that's where, people in my world are big on, you got to do a budget. You got to do a budget once a year, and you got to spend a lot of time doing that budget. And what I've found to be more useful to entrepreneurs starting out is actually making something more dynamic. And what is that? You do the budget once, and then each month you chop off the month that you just finished, and you add a new month to the future. So that way you're always looking out at the next 12 or 6 months, whatever's palatable. Again, if you make this into too much of a chore, I promise you won't do it. And you're always looking at the freshest data. One thing that I can predict for anyone who makes a budget is within 4 or 5 months, it'll be junk. You're never that good at looking out over the coming year. But what you can get really good at is looking out over the next 3 months, or maybe even 4 if you're particularly good at it. So as long as you're constantly refreshing this thing, it becomes much less of a chore because it's something that you pick up more often. The mechanics of it become a lot easier, and it becomes an actual tool versus something that you do look at once a year and then it goes in a drawer because it's no longer relevant to your business. And that's what I mean by dynamic. The other reason to plan for the future is it can affect your variable cost structure in ways that you may not have foreseen if you didn't sort of really think about where you want to be and what you want to do. And what I mean by that is, so I'll give you an example of, say you're starting out right now, you're making your own stuff. Right now your variable costs are, I got to pay for materials. I get the studio space at the generator, it's really cheap. I'm able to come in, my labor's free because it's me. That's how I price my product, and that's how I plan on my profit margins. So a year from now, I've decided that I want to be making 3 times the amount of the stuff that I am today. If that's not practical that you're going to be doing all that, your cost structure just changed because now you got to hire people. Maybe you got to rent your own studio space because you're going to outgrow the space that you have at the generator. The planning process is going to help you see that coming down the road with enough time where you say, gee, maybe I can't price this the way I've priced it anymore. Or maybe I should start talking to my supply vendors now about, okay, at what point am I getting a price break if I buy in bulk? Having a good plan lets you see these opportunities before they become problems later on down the road. And don't be afraid to ask for help. I don't know why logically I put that in here, but it's a big thing for entrepreneurs. A lot of people are going to offer help. Always say yes, because they don't always offer it later on when you need it. But never be afraid to ask for assistance with putting this sort of stuff together. And then kind of a simple statement, but just understanding where you're going is going to help you make decisions today that'll help ensure that you actually get there. That's a big reason why we're big on forecasting into the future. Cash flow versus profitability. By show of hands, how many people think that's the same thing? Good. You're all either really shy or very well educated on this topic. They are not, and they are both very important, but the way I would explain them to you is If you're in a survival situation on your desert island, your cash flow, the profitability, that's going to be like getting something to eat. I got to find something to eat. I got to get some fish. I got to get some coconuts. I got to do something. I got to replace these calories I'm burning. The cash flow is the water you need to drink. So if you're having profitability problems, that's a problem. That's a problem you can fix. If you're having cash flow problems for a prolonged period of time, that's urgent. And understanding the difference between those two things will help you make, again, better decisions around planning for them, where your profitability can be just fine, but cash flow may be lagging. A big component of that is understanding what's called your aging. And that's when I was referring to earlier, your accounts receivable aging reports and your accounts payable aging reports. In simple, your accounts receivable aging, that's going to be a reflection of when I send a client my invoice, how long do I give them to pay me? Do I give them 30 days? Do I give them 45? And do on receipt? That's your aging. And it allows you to sort of measure and manage to that. Your accounts payable aging is going to be how long do people give me to pay them? And usually one's going to be a little bit longer than the other, but by understanding those relationships and managing them, you can help ensure that you don't get yourself into an uncomfortable position with your cash. And I'll get the third point I'll get to a little bit later, and that's around managing inventory. So I've created another awesome example that looks really good. How many people, look at this and you know what, this isn't such a bad looking operation. For startup, out of the gate, January we're turning a profit and it's gradually trending in the right directions. This doesn't feel so bad. But if you start feathering in aging and understanding cash flow, how many people are still feeling that way when they look at this bottom line here? Right? Having this kind of information up front and understanding those relationships, I know if I'm going to start this thing, I need $4,500 stat. And it's going to be a little while of managing my vendors' expectations because they want me to pay them in 15 days and being really diligent about watching my customers because they want to pay me in 30. Understanding the difference, you can be plenty profitable and still be cash poor. And vice versa, if somehow you're fortunate enough to find yourself in a situation, and people do sometimes where you've got the inverse, where people are paying you really quickly and you're not paying your vendors until later on, it can feel like you're cash rich when really there's a debt accruing behind the scenes. Why does it matter? So when it comes to inventory, why does it matter what costs get included? Defining that's going to be important for many of you in a manufacturing setting. Costs that go into inventory. So inventory costs when you're an artist, again, I'm going to pick on jewelry makers because that's the easiest example for me to draw on. You spend $1,000 on materials over the course of the year, and you've only sold half of what you have. You don't really have $1,000 worth of expense, right? You've got value sitting in boxes in the corner over there. That's what's in inventory costs. And the reason why you want to understand what your inventory is when you're reselling something that you made, you don't recognize expenses until you sell it. It's on your balance sheet. It's on that other financial statement that entrepreneurs don't always spend so much attention to. And when it's on your balance sheet, that's money you've spent that you don't have for the rest of your operations. So you want to make sure that inventory isn't steadily going on this because that's money that's just gone from circulation until you're fortunate enough to sell it. Calculations on how you decide what goes into inventory, particularly if you get lucky enough that you're growing and you're starting to hire people and you've got a little bit more of a sophisticated operation, can get really complicated. Estimates are okay. That's a big thing that we have to give people permission to do. A reasonable estimate is a perfectly fine way to figure out what's inventory versus what's an expense. And then the reason why I say don't be blindsided by tax time is a lot of people, particularly when they're starting out, have that cash basis mentality when it comes to what am I going to be able to write off? What are my deductions? And I can tell you right now, if you're a sculptor who works with sheet metal a lot and you had a really good year and you go out and buy 20 grand worth of sheet metal in December because you're going to get that deduction, I got bad news for you when I'm preparing your return. That's an asset. That's not an expense. So now you don't have $20,000 to pay the taxes on the income that you made last year. That's where you can get blindsided if you don't truly understand what the relationship is between your balance sheet, your inventory, and your profit and loss, your cost of goods. I've given another example. I'm really jewelry heavy in this presentation. I'm reeling that now. To try and illustrate that for all of you, again, I apologize for the words, but this is as short as I could get it. So the example is somebody who manufactures jewelry buys $800 in materials and pays $200 in labor for a total of $1,000 in production costs. And what they were able to produce with that over the course of the year is something that retails, or a product that retails for $1,600. So those are the costs that are potentially either going to end up on the income statement or on the balance sheet. Over the course of the year, they sell half. So $800 worth of that jewelry gets sold. When they want to figure out, what's in my inventory versus what's in my cost of goods, it's as simple as there's quotation marks around simple, but since they sold half of the jewelry they had, they recognize half of the cost they incurred. So where some people might think I get a $1,000 write-off and I only have $800 worth of income, I actually have $800 worth of income and only $500 worth of deductions, which is good from a profitability standpoint. But again, if you're not prepared for that, it can be a little bit of a shocker at the end. Closing thoughts in this area, not all growth is good. And what I mean by that is businesses grow themselves to death as much as they suffer a long and slow demise. If you get too far ahead of yourself, and it's usually that other thing, the cash flow that gets you, you can easily bite off more than you can chew and find yourself in an uncomfortable position. So sometimes success can be something that you have to be as careful with as it's the negative consequences of a downturn. And by having a good understanding of your cash flow, your profitability, by doing that plan that's forward-looking, that can help you to do something that's terribly important that not enough people do, is know when to say no to something. It feels awful when you do it, but often it can be the right thing to do in the right time. And it also helps you to understand, if I do want to take on this opportunity, what does that mean? Do I need more investors? Is it time for me to go out and get that bank debt? It's a good thing I was paying attention to my balance sheet like Matt told me to, because now I know I can walk over to one of the many lenders in Burlington. I'm not going to play favorites and name any. How to keep track of it all. For many of you just starting out, the checkbook in Excel can be good enough. If you're serious about your business and you're growing your business, pretty soon you graduate to a point where I would never recommend to somebody not using some sort of accounting software. And there are a ton out there to pick from. And I'm sure many of them are very good. Most people in my profession are going to say QuickBooks because that's what we know and we're comfortable with, and it's reasonably priced. And for all the reasons I listed here, it can grow with you. It's got both desktop and remote versions. But the most important part is that you find something that's easy for you to use and that you relatively understand and that you're using something. Excel may seem fine until you have that first big mistake that ends up costing you money or making a bad business decision around it. A good accounting software package has some safeguards in to even keep you from messing anything up too badly. Designing the right system, being realistic about how much time you're going to put in is a big one. You don't want to make an accounting system that's so complicated that you only work on it once every 3 months, because guess what? That's a chore, and it's not helping you in your business at all, and you're not getting accurate results. So that's where things like designing the chart of accounts are going to use, deciding, which products am I going to measure profitability on. Make it simple and be realistic about what kind of time you have to put in and what kind of resources you have to put into that. Because if you're not going to keep up with it, if you're not honest to yourself about what you're going to keep up with, it's just going to be something that isn't any use to you and becomes a daunting task versus something that can help guide you along the way. don't forget other things like the back office. And I've taken the time to list a few things here that would apply to artists that many of you probably wouldn't think of going out the back, or going out the back. Starting off, I guess is what I was trying to say. That is sales taxes. You guys owe sales taxes on the stuff that you sell. So that means you got to get registered with the Vermont Department of Taxes. You got to get a sales use tax ID number. You got to know what your filing frequency is, and you got to know how to calculate, bill your clients, and remit that. Likewise, though, when you're a manufacturer, you don't have to pay sales taxes on the material that you're buying to produce with. That's important because that's a 6%, 7%, depending on if you're buying it someplace. So these are things that you should be aware of. If you have payroll employees, I put payroll filings up here. Generally, my advice is use a payroll service. Don't try to do that yourself. And I stand by that advice. But knowing that, once you're a business and once you're operating like a business, if you pay somebody for services, you now have a 1099 reporting requirement. So these are things you need to have on your radar just to make sure that you don't accidentally run afoul of something when you're focused on your business. You don't have to devote all your time to it, but you should at least know that it's a thing and roughly when it needs to be done and when you need to ask for help. And again, I think I've played this out pretty often tonight, but whenever you're designing one of these systems, you want to take care that you're making it as simple as possible. You can always add complexity later. You don't need a chart of accounts that's 100 accounts long. You could probably maybe start out with 5 and then add them as you need them. The more complicated you make a system, the more opportunities for error there are in that system, and the less likely it is that you're going to keep up with it. And that's a guarantee that I can give to all of you. And with that, I was promised that you guys were going to rake me over the coals tonight. And I'd like to open it up to any questions.
Want me to run? You point and I'll run. Okay. Who's got a question?
So you all can go out and do your accounting just fine from here. I have one question.
Yeah.
So my art is that I'm a hat maker, which is in Vermont, hats are not subject to sales tax, I know, because it's clothing. My question is, and obviously I'm also selling on, most of my sales are online, so they're out of state. But so now like Etsy is charging sales tax to those customers and remitting it directly to the state. So I guess I kind of have two questions. One is, I have an accountant, so I'll just be reporting that to her for like whatever I need to let her figure it out. But how do you figure out like the line with art, like what category you're in? Because some of my work is starting to veer more toward like not jewelry, but like like hair accessories, kind of thing. Like
it is super subjective. It particularly with sales taxes, and particularly when we're talking about out-of-state sales online, which I'm sure most of you are dabbling in at least a little bit. It's subjective, and often you won't get a clear answer from the professionals in your life, like I'm not giving you right now. Okay. Because often you have to take a position that you're comfortable with and that you feel like you can support. And at the end of the day, the thing is going to be, do you have a reasonable argument for it if it falls into question, or are you trying to call, a bracelet, a mitten?
Okay, cool.
Hi. So I was wondering, do businesses normally factor in taxes into their fixed or variable costs when they're doing those formulas?
So I want to ask a clarifying question, but I'm going to answer both. Do you mean sales taxes or do you mean income taxes?
Sales tax.
Sales taxes, no, and here's why. When you're collecting and remitting sales taxes, and plenty of people do it this way, it should never really actually hit your profit and loss. That's never really your money. You're just taking custody of it for a period of time until you've given it to the taxing agency. So it's not an actual cost. It's not revenue either when you're collecting it.
Because you're normally charging the customer the
Right.
tax.
You're collecting it on behalf of the jurisdiction, somewhat altruistically. Yeah. Good question. And I promise if you do have questions, there's probably at least 10 other people that have the same one.
Okay, so I have a really maybe basic or slightly
No such
silly,
thing.
dumb question. For those of us who are still in the Excel phase where we don't need QuickBooks, do you have a layout suggestion for these balance sheets or for sort of figuring that out to be able to see it all?
If you're dabbling in a balance sheet, I might argue that you are graduating. Some of the, I push QuickBooks, but there actually are some that you can start for free. I would say the layout needs to be something that makes sense to you. And that's really my main caveat. Maybe if you use an accountant to prepare your taxes, it should make sense to them too. But it's got to be practical, and it's got to be something that you can use, look at, and understand. Beyond that, I don't have a strong opinion one way or another. It usually goes from top to bottom. So if you're one of those people that thinks this way, I'm not going to follow that.
Right. I guess I worry that if I do my own layout, I'm missing things. You know what I mean? I don't see everything. And so that's where I wonder if that could come into play.
I think, so I'm going to answer a question you didn't give. And one thing about, that being afraid you're going to miss things, that right there, that kind of fear that I'm going to miss something is the number one reason people don't even start keeping their books, don't even start really delving into this stuff, because it becomes such a big insurmountable thing in their head that they don't even know where to start. Start simple and work from there. And then two is, if you really are paying attention to the kinds of things that I'm talking about tonight, you probably are a step above. If you're in Excel, it really should be, I'm watching my checkbook and I'm just keeping track of who paid me and what I paid them. There's usually not a lot of balance sheet if you're still doing Excel. And the main reason why is you can make some fantastic mistakes in Excel, and you can do them really quickly, and you can make them look super cool. And there's no safeguard to make sure that every time you put an asset, you're also putting something over here, and vice versa. That's why I'll kind of steer you away. If you're at that point, it's time to maybe look at a QuickBooks, or if I think Xero or Wave. There's a few out there that have some. It's sort of a bait and switch where they have this really base model that you get for free, but the second you want to do anything, then you start charging. But you can at least get started and get a feel for it. And the good news is that's a business expense, so you do get a deduction for it. Anyone else? No?
How do I work with an accountant? How do I work with a bookkeeper? What kind of questions should I be asking? What does the relationship look like? Am I on the clock the second I call them? Can you talk a little bit about that?
Yeah. No, it all completely depends. I am a big advocate for the most important thing with a relationship with a bookkeeper or an accountant is that they feel right to you. You can have the best accountant in the world, and if you don't trust them, if you don't really feel confident in that relationship, you'll never take their advice wholeheartedly, and so you're never going to get the value of the fees that you're paying. Number one, how does it feel? Do I trust this person? Do I feel like this is a relationship? Do they talk to me in a way that I understand? Because we all communicate differently. I think that's really important. I could certainly coach people on some really tough technical questions to ask to try and weed them out, but you want to make sure that they're experienced, they've got reputation. I mean, there's a little bit of online out there for if you want to look up if anyone has any reviews. I'm not sure what all the sites are, but occasionally if you Google, you can find somebody yelped about it or some equivalent of that. But generally speaking, if it's somebody in the profession and they do it, it's more about how does the relationship look and feel to you, and making sure that you're going at the right speed. So for a lot of people just starting out, TurboTax or an H&R Block can be the right tax preparer for you. If you start having a small staff, you start having, maybe I should be an entity, now you're graduating levels. So making sure that you're not necessarily outpricing where you are. And the reason why I say that is you don't want to, if you're only making $10,000 a year net, you probably shouldn't pay me $2,000 to prepare your tax return. It's that kind of cost-benefit analysis that you need to do. And the main things that you're going to get at the higher level prepare level is they're going to be the ones who are feeding you those great planning opportunities. And, here, now that you're making some money, let's save you some money. So it's a little bit unclear the way I've worded it. But ultimately, I think it's going to come back to look and feel as much as anything. Don't hang on to the bookkeeper for longer than you should, or the bookkeeping for longer than you should. That is something that's common with entrepreneurs, is that they continue thinking that they're going to do something that they eventually just stop doing altogether, and then it becomes a big production at the end of the year. If you do get to a point where you're busy enough, where the bookkeeping's enough of a chore, and where your time could, quite frankly, be better spent elsewhere, time to stop doing it, time to bring someone in.